Okay, Bismillahirrahmanirrahim. Today our topic is indirect taxes. What are the different types of indirect taxes and how their tax burden can be shifted to others? Remember, we defined indirect taxes that these are the taxes in which tax burden can be shifted to others. Like if tax is imposed on the sellers, so the burden of the tax will be shifted on the consumers as well. So the tax burden can be shifted to others. This is called the indirect taxes. Whereas the direct taxes are those in which tax burden cannot be shifted to others. A person who is liable to pay the tax, he has to bear its burden. Okay, so indirect taxes are those in which tax burden can be shifted to others. Like these are called the expenditure taxes, like sales tax. If seller is selling a product and he is imposed a tax by the government, but he is not himself bearing all the tax burden, but he is sharing his burden with the consumers as well. So when tax burdens are shared with the consumers, then we say this is called indirect tax. We all know what is meant by total revenue. Total revenue means price into quantity sold by the seller. Keep it in mind, this is the revenue of the seller, and at the same time it is the expenditure of the consumers. So consumer is spending his income to buy the goods and services. So can I say this is the total expenditure of the consumer, whereas it is the seller, from the seller's point of view, it is going to be the revenue from the seller's point of view. Okay, seller's revenue, we can calculate the seller's revenue by multiplying the price with the quantity sold. Now there are two main types of indirect taxes. One is called quantity tax or per unit tax or specific tax. Alright, whereas the other tax will be called value added tax or ad valorem tax. Alright, so these are the two main types of indirect taxes. One is called quantity tax and another is called value added tax, or you might have descended in the form of VAT, value added tax. So when this tax is imposed on the quantity produced, when it is imposed on the quantity produced, then we say it is per unit tax or the quantity tax which is imposed on the production of a good which is having demerit characteristics, like it is harmful to the consumers, but consumers do not realize the harmful effects by themselves. So a third party will be playing the role of value judgment in that case. So when it is imposed on the production, we say it is quantity tax. It is also called per unit tax. So it is named as specific tax as well. Whenever this tax is imposed on the price of the product, like it is the percentage of the price of the product, then we say it is a value added tax. What it is? A value added tax will be imposed on the price of the product, and it is the percentage of price. It is also given a name of ad valorem tax, whereas the quantity tax is imposed on the quantity produced. Okay, now the quantity tax, first of all, the quantity tax The quantity tax. It is imposed on the production of the goods. So can I say it is per unit tax? For example, tax is rupees 10 per unit. When 1 unit is produced, there is 10 rupees tax. When there are 2 units produced, the tax will be 20 rupees. And when 3 units are produced, the tax will be 30 rupees. So we can say the tax is imposed on the production. Here, when tax is imposed on the production of the goods, then it is same like increase in the cost of production. As the cost increases and supply will shift leftward. So here, when tax is imposed, what happens? Supply will shift leftward. Where it is shifting? It is shifting leftward. So the gap between these two supply curves is the amount of the tax. This is the amount of the tax. You can see this is a parallel leftward shift due to the imposition of a tax. So whenever we find the quantity tax is imposed, there will be parallel leftward shift. It is same like increase in the cost of production of the producer. Therefore, the gap between these two supply curves is the constant value. This is the amount of the tax which is imposed by the government. Now, for each unit, the tax is same like 10 rupees per unit. This is the amount of the tax which is paid, which is imposed by the government. So, whenever we find that there is going to be value added tax, what it is? Value added tax, or say it is VAT or ad valorem tax. This is a percentage of price. It is percentage of price of the product. Like you buy a pair of shoe. So whatever the price of the product is there, on its price there is 20% is the tax. So this is VAT is equal to 20% of price. For example, if a product price is 100 rupees, so its tax will be rupees 20 now, because 20% of 100 is 20. Now if its price is 1000, what is the price now? 1000 is the price. Now tax will be 200. So you see over here, the percentage or the rate of the tax remains same, but as price increases, the amount of tax revenue of the government will also increase. As this value added tax is percentage of price, can I say when price is 2000 rupees, so tax amount will be 400. So as the price is increasing, the amount of tax is increasing. Therefore, this value added tax or ad valorem tax, it will also cause a leftward shift, but it will be a non-parallel shift. Here we found the parallel leftward shift due to the quantity tax, whereas due to ad valorem tax or value added tax, there is non-parallel leftward shift, or there is a pivotal shift of the supply curve. See over here, as price is lower, the amount of tax is less, and when price increases, the gap between these two supply curves will be increasing. This is the amount of the tax will increase as the price is increasing. So in case of value added tax, we say there will be the pivotal shift of the supply curve towards left, and the gap between the two supply curves, that will tell us how much is the amount of the tax which is paid or imposed because of the increase in price, because rate of the tax remains same. Here the tax amount was same on each unit producing quantity tax, but in case of value added tax, it is the percentage or the rate of the tax which remains same. When price changes, there will be the change the tax revenue of the government. Okay, now I am going to analyze first of all the quantity tax in front of you. Like if government is imposing a tax equal to 10 rupees on each unit produced, like it is a demerit good. So when demerit good is produced, in order to discourage its consumption, government can impose a quantity tax. So here I am taking the example of any demerit good, you can say alcohol or cigarettes. So this is the demand curve before the tax. This is the supply curve before the tax. This is market equilibrium point, which is E1 before any tax is imposed. This is quantity Q1, and this is the price, you can say 50 rupees is the price before the imposition of a tax. And how much quantity is traded? You can say there are 1000 units which are traded at this market level equilibrium, where demand and supply, they are balanced with each other. Whatever is demanded, it is supplied at this equilibrium price. So when a quantity tax is imposed, quantity tax is imposed. So what will happen to the supply curve? It will have a leftward shift. Now at the rate of rupees 10 per unit. Remember, it will cause a leftward shift of the supply curve, which is now having a parallel leftward shift. Now a new equilibrium is formed at E2. A new equilibrium is formed at E2. Draw the price now and draw the perpendicular to show the quantity. Now the quantity has decreased. What is happening? Government has imposed a tax of rupees 10 per unit. How much will be the price after the tax a consumer is going to pay? We see this is the price paid by the consumer after the tax, and the seller will receive this lower price. You can say when government has imposed this tax, the price for the consumer is now higher than before the tax. As we see, when tax was not imposed, seller was receiving 50 rupees, which was paid by the consumer. The seller was receiving the same amount as it was paid by the consumer. Now due to tax was imposed on the seller, on the production, and he himself is not paying all the amount of the tax. He is shifting some of the burden of this tax on the consumers. So what will be the price which will be paid by the consumer? We say this is the price 55 now, which is paid by the consumer instead of 60. You might be thinking that the consumer will be paying 60 price. Keep in mind, he is not fully shifting the burden of the tax on the consumers in this case. Now after paying this tax of rupees 10 out of these 55 rupees, how much will be the leftover with the seller after the tax? This is the seller price, which is now 45, because after paying tax out of this 55, he is left over with 45 rupees. So tax amount was 10 rupees imposed by the government. Out of these 10 rupees, 5 rupees burden was shifted on the consumers, whereas the rest of the 5 rupees, they will be borne by the sellers. So these two rectangles, they are showing us the tax revenue. Upper rectangle is showing us how much tax is borne by the consumers, and lower rectangle is showing us that how much tax is borne by the sellers. So collectively, if we say the quantity produced is now 800 units, how much is the tax revenue of the government? In this case, tax multiplied by quantity sold at this level, so tax is 10 rupees and 800 units are sold, we say 8,000 rupees are collected by the government in the form of a tax where 800 units are sold. Okay, out of this 800, 400 was paid by the consumers. 8,000 out of this 8,000 tax revenue, 4,000 was paid by the consumers, whereas the rest of the 4,000 was paid by the sellers. So sellers share the burden of this tax with the consumers as well. Okay. Now, if you see, there are these two triangles which are also formed along with the tax. Okay. So when we talk about these two triangles, what are these two triangles? Actually, the upper triangle is showing us what? The loss in consumer surplus or the consumer welfare. We know that the area under the demand curve that tells us the total consumer surplus. How much is the fall in total consumer surplus? Keep it in mind, this rectangle was taken by the government in the form of tax revenue. And this triangle, this is the welfare loss of the consumer due to the tax because of the reduction in the output level. This triangle is showing us nobody has paid this thing. This is the loss in welfare of the consumers due to tax. This is called consumer surplus loss. Whereas the lower triangle that is showing us what? The loss in total producer surplus. Remember that what is total producer surplus? That is the area above the supply curve and below the market price. Now previously this was the part of producer surplus. Now due to reduction in output level, he is also sacrificing this much of his welfare. Collectively, these two triangles, they are called what? They are called what? Deadweight loss. Deadweight loss due to tax. What is happening? This is called deadweight loss due to tax. We are finding that when a tax is imposed, government is collecting this revenue, but these two triangles are showing us that we are having a deadweight loss in the society due to the imposition of the indirect tax. Okay, now who is bearing more burden of this tax whenever this tax was imposed? Who is bearing the more burden of tax? It depends upon the relative price elasticities of demand and supply. What I said? Listen it carefully. Who is bearing more burden of the tax? It depends upon the relative price elasticities of demand and supply. In this case, 50% of tax is shared by the consumer, whereas the rest of the 50% is shared by the producers. Because the size of these two triangles, they are equal in size. If they are having variation in the sizes, any of the triangle is larger in size, that means if upper triangle is larger in size, then consumers are bearing more burden of the tax. And if the lower triangle is going to be larger in size, then sellers will be bearing the more burden of the tax. So here in this case, we see relatively price elasticity of demand is equal to price elasticity of supply, whatever their elasticity values are there. And they are bearing equal burden of the tax. Equal burden of the tax. Okay. So now I will be drawing another diagram which is having different elasticities of demand and supply. Price elasticities of demand will be different from the price elasticity of supply. Then we will see the same amount of tax imposed by the government will have different tax burdens on consumers and producers. Okay, the shifting of burden from sellers to the buyers, that is called tax incidence, that how much burden is borne by each one, that is called tax incidence. Now I am erasing this diagram and will be drawing a new one where the difference of elasticities will be present. Okay, you can see over here. Now I am drawing the demand which is relatively inelastic than supply. Demand is now inelastic and this is the supply curve. This is the equilibrium E1 before the tax. Now the same tax is imposed. Here we find that consumer will pay the upper price and seller will receive the price along his previous supply line, where this perpendicular is intercepting his previous supply line. This will be the price received by the seller after the tax. Now seller is receiving this price. Suppose the same tax is imposed. Before the tax the price was 50 rupees. Now see the upper rectangle, that is now larger in size. And look at this triangle, it is larger than the lower triangle. That the loss in consumer welfare is more than the loss in the producer welfare. So now the price paid by the consumer is 58 rupees and seller is receiving 48. After paying 10 rupees tax from this 58, he is left over with 48. Previously consumer was paying 50 rupees and seller was receiving 50 rupees. Now after the tax, consumer is paying 58 and seller is receiving 48. Why? Now out of this 10 rupees tax, 80% of tax is paid by the consumer. 8 rupees price has increased for the consumers. 80% of this tax is paid by the consumers, whereas seller out of these 10 rupees, he is only paying 20% of the tax. Whatever the quantity you can write here. Now 1,900 units are produced now. The tax revenue will be now 9,000 because demand is inelastic. Quantity hasn't decreased by more proportion. Okay. Now see, so we have this increase in price for the consumers by 8 rupees. So out of 10 rupees, 8 rupees are paid by the consumers, whereas the rest of 2 rupees they are paid by the seller. Now what are these two triangles? Look them carefully. The upper triangle is larger in size. That shows the consumer welfare loss due to tax. Okay. So when demand is inelastic, now see, price elasticity of demand is lower than price elasticity of supply. More tax burden is on consumer. More tax burden is on the consumers, where we find due to inelastic demand, we find that more tax burden is on the consumer and seller supply is relatively elastic than demand. So that's why he is shifting more burden of this tax on the consumers and paying less tax from his own pocket. So the lower triangle is showing us this is smaller in size because supply is elastic and consumer is paying more tax because demand is inelastic. This area, this shaded area, you can say this is the tax revenue collected by the government, and these two triangles are showing us what? The deadweight loss due to this indirect tax. Okay. Now I am going to draw inelastic supply. What happens in that case? Okay, see over here, I think you can easily understand when supply is inelastic and demand is elastic. Before tax, this is the equilibrium where the price was 50. Consumer was paying 50, seller was receiving 50. This is the 1000 units which were previously traded. Now tax is imposed, supply will shift leftward. There will be parallel leftward shift. It is now a steeper one. We have to draw a parallel supply line. Okay. Okay, now this is the supply side. See over here, this is the after tax equilibrium. Consumer. See, now quantity has decreased by, you can say, 700 units. Demand is elastic now. Now consumer is paying this price, like I say, 52 rupees, whereas seller is receiving 42. This is the seller price. You can see after the tax, seller is paying more tax from his own pocket because his supply is inelastic. Consumers are price sensitive. If price is slightly increasing, they are decreasing the quantity demand by more proportion. That's why he has shifted only 20% of this tax burden on the consumers. So upper rectangle is smaller in size, that is the tax paid by the consumer, whereas a lower triangle that is having larger size, that the more tax is paid by the seller. Look at these two triangles. What is happening? Upper triangle is smaller in size, whereas a lower triangle that is larger in size, and it shows that when price elasticity of supply is less than price elasticity of demand, what happens in this case? We find that more tax burden will be on the sellers, or producers. This is again the dead weight loss of the tax. Okay. So now we see when demand is elastic than supply, then sellers are bearing more burden. So if demand is perfectly inelastic, remember, this is the perfectly inelastic demand. You can say this is the perfect necessity. Keep it in mind, government is imposing taxes on inelastic demand because consumers will not be decreasing their consumption by too much. Now see, this is before tax equilibrium. I say 50 rupees is the price, 1000 units are traded. Now when tax is imposed, consumer will bear all the burden of the tax. Now price will be all inclusive of all the tax because demand is perfectly inelastic. We see when price elasticity of demand is zero, all tax burden will be paid by the consumer, or tax burden will be on the consumers. Because its supply is perfectly inelastic, then all tax will be paid by the consumers. So this is what, when we have elasticity differences, the burden of taxes will be different. Now if demand is perfectly elastic, now, this is perfectly elastic demand. Now before the tax, this was the price, 1000 units were traded. Now supply will shift leftward after the tax. Now consumers will not increase their price because if price slightly increases, there will be infinitely zero demand of this product. Now all tax will be paid by the seller. All tax burden is on the sellers. See, when price elasticity of demand is perfectly elastic, all tax burden will be on the sellers. Alright, this is all about for indirect taxes for today, and tomorrow we will be doing value added taxes and subsidies. Inshallah, that's all for today. Thank you very much.